Hello, everybody. Ed Yardeni here. Thanks for joining me today. I hope you all had a great weekend, a great Father's Day for those of you who are fathers or who had a father and mother. So you must have had a father. But anyways, I hope you enjoyed it, particularly those of you who are fathers. I had a good session here with my kids and my wife and my mother-in-law and our 4 dogs all together. And so we had a good barbecue. We've also had remarkably good weather. I hope that's been true for you. I mean, usually we go from winter to summer pretty quickly here. We've actually had a spring this year, so we've enjoyed the weather for sure. Hope it's nice where you are. Speaking of nice, the market's been nice. It's been going up rather on a regular fashion here. It's certainly moved a lot faster than I had been expecting. I thought 4,600 by year end, and here we are already at 4,400. I'm not going to change my target at this point. I'm going to leave it for now. I've seen some of the competitors out there, much bigger competitors than our little shop. Goldman, I understand, went from 4,000 to 4,500. On the other hand, Morgan Stanley, Mike Wilson apparently reiterated his bearish stance on the outlook for earnings. And from what I gather, he's saying that inflation is coming down, and because inflation is coming down, that's going to be bad for profits. The idea, I guess, is that inflation has been good for revenues and therefore good for profits. But Mike thinks that lower inflation is going to be bad now for profits as a result of that. I think he'll be right. If we have a recession and that brings inflation down, that certainly would be bad for earnings. I think he's talking about $185 a share this year. We're quite a different story. We're looking at $225 a share for this year. So it's take your pick and let's see how it goes. But our thinking is that higher inflation actually turned out not to be that great for earnings. Rising inflation certainly did help revenues, and we've been indicating that, highlighting that. But on the other hand, higher inflation has knocked down profit margins as costs have been rising faster than prices. And so now I think our thinking is that as inflation comes down, while we may lose something on revenues growth, that'll be more than offset by an improvement in the profit margin. Besides, you know us, we're talking about the roaring 2020s and how technological innovation is going to be a great booster for productivity, which would also be very good for corporate profit margins and corporate profits generally. Well, with that brief intro, let's look at some of the charts that are relevant to this discussion today. So we're looking at our chart collection for the morning briefing. And it's today's date, March 20th. You can see that we continue to follow the weekly indicators for corporate revenues, corporate earnings, and margins for the S&P 500 corporations. And sure enough, we've had a really strong surge in forward revenues, and they're now at a record high. And they're awfully good high-frequency coincident indicators of actual revenues, as you can see from this chart. That chart shows actual revenues simply annualized by multiplying by 4. Here is earnings per share. This is, again, the actual. And again, this is just multiplied by 4 to annualize it. And we use the IBIS Refinitiv data. We have used it for a long time and have an affinity for it. We think it reflects what analysts are thinking, and that's what the market is discounting. And so here you've got the forward earnings also being quite a good weekly indicator of the quarterly data. And that seems to be just turning up just a tad here. And we find it to be a very useful weekly indicator of what's going on, not just for earnings, but also for the economy. And not just for the domestic economy, but also the global economy. Here you can see that since we have these 4 series for revenues And for operating earnings, we can calculate forward profit margin. And you can see that took a drop here and it now seems to be edging up. And that correlates really well and tracks real well the actual quarterly profit margin. So that's, we think this is the beginning of, we think it's bottom, let's put it that way. I'm not telling you it's going to go right back straight up, but we do think that it's bottom, in which case, if revenues continue to grow in an economy, global economy that's growing, this should be going up. And if the profit margin is flat, earnings should be going up. So that's kind of the overview. Now let's get to the specifics here. Again, Morgan Stanley, Mike Wilson's talking about $185 a share. We're using $225 a share because we don't expect a recession. We think that low inflation will be good for profits on balance, boosting profit margins more than we lose on the revenues growth side. Then next year, we're looking at $250 a share and then $270 a share. So you can see our forecasts here. And by the way, we post this on the website as the YRI earnings forecasts. And meanwhile, we're on this chart, we're also tracking the analyst expectations. We're kind of monitoring them and marking our forecast to their forecast. And typically they tend to be too optimistic and have to lower their numbers. But there's been so much recession talk that we're taking a bet here that the numbers will turn out to be somewhat better than they're thinking. Looks like this number isn't too bad for 2025, but 2024 is a little bit below our forecast. And you can see the numbers for them over here. So this is the actual earnings per share, and then our numbers, and then the analyst numbers. The profit margin implied by our, let's see if I gave you the chart for revenues. No, okay. So there is a chart for revenues with its forecast, and that's in that publication posted on the website. But you can see here we've got the profit margin resulting from the data that's available for revenues and for earnings, and as well as our forecast and the analyst forecast. And you can see that our forecast implies that the profit margin is going to go up to 12.3, 13.2, 13.7, and this is what it looks like. Now, some of you might wonder, why would profit margins be going to a record high? And that goes back to our roaring 2020 story. If that works out, then we think profit margins will achieve record high by 2025. Here's the market again. The Morgan Stanley projection is that this is basically a rally in a bear market, and that we're going to have another sell-off. And the number I saw in the papers that they're talking about is 3,900. 3,900 is down 11% from here. That's more like a correction that there's a bear market, but I guess they'd be looking at it in the context of this bear market. I'm quite convinced, Joe and I are quite convinced that earnings bottomed, that the market bottomed on October 12th, that we're in a bull market. We've got higher lows, higher highs. This one made another high. We could certainly have some sell-off here as in a correction mode. I hope we do. It'll be good for the market. Probably revive all the debate about whether this is a bull market or this is just a rally in a bear market. But even if we got down to the 200-day moving average, that would be actually less than a correction. That would be something like 9%. So that's what the market looks like, and that's what it looks like to us. Meanwhile, there was some talk a few weeks ago that because the breadth was so narrow, that was a setup for a major sell-off in the market. And our argument was, well, yeah, the breadth is narrow. The mega cap eights have caught on again. But a lot of that narrowing occurred since the banking crisis back in March. And financials got pummeled and energy stocks got pummeled because the price of oil was going down. And the price of oil was going down partly because the global economic outlook just isn't all that great. China looks like its recovery from the pandemic has been kind of weak. They are looking to stimulate, so that could turn around pretty quickly. And meanwhile, here in the United States, the fear was that a banking crisis could cause that widely anticipated recession, which would be bad for oil. But our position, even early on in the banking crisis, was that this too shall pass, that the Fed fixed things with another liquidity facility, and that we would not have a recession, an economy-wide recession, but we could very well continue to have a rolling recession with the commercial real estate market going into a recession. To be very specific, we're talking about offices. We're not talking about necessarily malls or hotels or distribution centers, warehouses. So it's not just kind of an across-the-board pummeling of the commercial real estate market. Mostly offices, and mostly old office buildings that can't be converted into apartments. So meanwhile, the market has broadened, wouldn't you know it? Over the past couple of weeks, you've seen that the percent of S&P 500 companies with positive year-over-year price changes has picked up to over 70%. The same thing goes for our, Joe Abbott came up with this clever chart where he's looking at the percent of S&P companies with positive 3-month percent changes in forward earnings. So it's kind of a breadth of earnings, if you will, and you can see that that's picked up quite a bit. Typically in a recession, this thing takes a dive, and then here it took a dive, and then it recovers. So we haven't had a recession, but these are actually bear markets. So we've had a bear market, not much of a bear market, kind of like a correction that turned out to be a bear market for a few days. But things have improved on the earnings side from that perspective. Again, the talk was that this mega cap 8 market cap was accounting for all of the gains in the market. But as we just saw, I think that's starting to change. And it certainly started to change big time in June. These are the June percent changes so far, and you can look at it on your own. They're pretty impressive and across the board increases for the market for the 11 sectors of the S&P 500. Impressive here is we thought that the banking crisis would not morph into an economy-wide credit crunch, that there wouldn't be a kind of a bunch of bank runs. We didn't think it would even turn out to be like this SNL crisis, the 1990s. It still could, but it doesn't look like it's doing it. And we don't think it will, in which case the financials got pummeled to an extreme extent and have some opportunities here to rebound, and that'll help to broaden the market, and that's already started in our opinion. And it started because people are watching the weekly loans and lease numbers that the Fed puts out on commercial, on all loans, not just commercial and industrial, but on all loans. And you can see that this is looking like it's kind of flattening out. I wouldn't say topping, but this doesn't look like a real calamity so far. This is a small and large banks, large and small banks, I should say. Here's the industrials. We pointed out a few weeks ago that you really want to keep track of onshoring and infrastructure spending because it looks like the money is really pouring in to build more manufacturing facilities here in the US, and the industrial stocks are starting to really reflect that. I mean, we're basically back to where we were at the peak of the industrial stocks before the bear market. And it's got a pretty good shape here and looks like it's going to break out to new highs. That's on the mid caps. This is the large caps, same kind of story, basically. And here's that chart that I showed you. That's just an eye opener. This is construction put in place of manufacturing facilities, manufacturing plants, just going straight up. And this may just continue to kind of go off the charts here, given how much money is pouring into all kinds of manufacturing. Meanwhile, the bull-bear ratio suggests that people are getting more comfortable with this market. This is actually a combination of the AAII survey and the Investors Intelligence survey, and you can see that there's been a big pop here in the net percent of bulls minus bears. It's not a ratio, it's just subtraction. Well, this may be somewhat worrisome to contrarians. We like to be contrarians, but we don't do it just to be contrarian. We think this just indicates that there's less fear and more greed coming into the market. And some people have characterized this. I would characterize it even as a melt-up situation, because it is kind of trading that way. And maybe that sets us up for a meltdown, but I don't think so. I think the fundamentals, I think the markets are correctly anticipating some really good fundamentals. As, by the way, we just got this morning in housing starts, which, surprise, surprise, were up a great deal in May. We can look at that in a second. Here's another, this is the S&P 500 relative to its 200-day average. And again, we're up over 10%, and I'll concede that, no, it could take a drop here. But going back to the 200-day average would basically be a correction. Certainly not a bear market, but the bears will argue it's a resumption of their bear market. So that's what makes this market interesting. Meanwhile, one of the bearish arguments out there, pessimistic arguments about the economy, is that the only reason that it's doing resilient and been doing surprisingly well in the face of a 500 basis point increase in the Fed funds rate is because there's still lots of cash left over from all the stimulus that was provided during the pandemic, with those 3 checks, with people stashing money away for a couple of months. And by some estimates, there's instead of $2 trillion or $2.5 trillion of excess savings, there are now 0.5 trillion, which is still a lot of money. And that could keep the economy going for a while longer. But once those excess savings disappear, guess what? The consumer is going to be without money, and we're going to have a consumer-led recession. That's not my story. My story is that there's a lot of sources of income growth for the consumer. Wages are starting to rise faster than prices. There's also, it's not just wages and salaries that drive, it's not only wages and salaries that drive personal income, but what's also a very important factor is receipts of unearned income. That's this one. That's interest income, which is up. Dividend income, all-time record high. Rental income, that's got to be doing pretty well. And proprietors income, which is what small businesses that are owned by one person are doing. And they seem to be complaining a lot that their business is being challenged because of inflation and interest rates. And yet, when you look at proprietors income, it's an all-time record high. So put it all together, and receipts of unearned income are doing quite well. And as I've said before, and I will update in more detail, that the baby boomers are sitting on $73 trillion of net worth, assets minus liabilities. And so they have a tremendous amount of money. They are being forced as they retire to take their 401k distributions. They're getting Social Security. There's a lot of money that consumers have access to. So what about this increase in initial unemployment claims? Well, we know that companies here and there have been cutting back in order to increase their, reduce their costs, increase their profitability. You can see that this is quite highly correlated with jobs hard to get survey data, which remains very low. So we're not terribly concerned about this. We could see some modest increase here. But of course, if it's modest, we should welcome that, because then it would increase the likelihood that the Fed is done, which is still our opinion. Meanwhile, again, the labor market, other indicators of job openings remain quite high. They're nowhere near the more normal levels here. Maybe they're heading in that direction, but right now they still remain quite high. So the labor market's strong. So when you look at the consumer, we had retail sales. Retail sales turned out to be better than expected, 0.3. Inflation was 0.1. So there was a slight uptick in inflation-adjusted retail sales, but they're flat. They're flattish for inflation-adjusted retail sales, consistent with what we're seeing in real consumption of goods, because that's what retail sales are all about. but the services economy is still doing quite well. I promised you we'd look at housing starts. This is housing starts taking a shot up here in May. Single families up, and look at multifamilies also extremely strong. So it's hard to see a recession here. I mean, we had a rolling recession in housing, and now it looks like it seems to be over. So that's speaking of over, my monologue is over. Let me take a little breather here at the whistle, and let's have a look. I've got to put on my other glasses. Let's see, Leonard. Oh, never mind. Willem, do you believe the 50 basis points of rate hikes predicted by the Summary of Economic Projections, SEP, will materially raise the risk of a recession if they are actually implemented? Good question. My gut feel is the economy has been so resilient to 500 basis points. I'm not sure that another 50 basis points would necessarily cause a recession. And I think the resilience has something to do with the excess savings, but I think the resilience also has to do with the fact that it's a very diversified economy. A lot of debt has been refinanced at record low interest rates. So no, I'm not convinced that would cause a recession, but I might have to increase the odds of it. Right now I'm 70-30 on 70 slow growing economy, soft landing, 30 recession. And now I'm thinking of maybe lowering that to 25% recession. I know Goldman beat me on that one, and they're not talking about 75-25. Ted, obviously inverted interest rates play a part in forecasting recessions, but can take a long time to affect the economy. What's your feeling on this factor? I'm glad you asked that Ted. Yeah, the yield curve is inverted. It's one of the 10 components of the index of leading economic indicators, which have been basically falling since December of last year. And that isn't good. That's has a pretty good record of predicting recessions with something like a 12-month lead time. That's the leading economic indicators. But the yield curve, the inverted yield curve, also has a good track record of calling recessions. Maybe the record is so good that it's overdue to be wrong. It hasn't. Neither the LEI or the inverted yield curve has been wrong predicting recessions for the past 8 recessions. So that's quite an accomplishment. And here, silly me, I've been delusionally saying, well, they're not going to work this time. I've shown you charts of the LIE, year-over-year percent change, versus the manufacturing PMI, and the correlation is extraordinarily strong, which leads me to conclude that the LEI is very biased towards manufacturing and doesn't capture services enough. And so I think that's one of the reasons I'm not too concerned about the inverted yield curve or the drop in the LEI. Also, I think people really, we're so used to focusing on monetary policy that we don't really spend much time thinking about fiscal policy, but fiscal policy is extraordinarily stimulative. It's never been this stimulative in what's supposed to be a recession, which is why we're not getting a recession. So if you've got very tight monetary policy, in the past, tight monetary policy would have caused a financial crisis, caused a credit crunch, caused a recession, and here we'd be in a recession right now. What's different this time isn't monetary policy. I mean, it's actually tighter than ever, than Volcker anyways. What's really different is the fiscal stimulus. By the time that the fiscal authorities got around to stimulating the economy during previous recessions, it was already over. This time around, we've had all this fiscal stimulus that really wasn't so much aimed at avoiding a recession as just providing all sorts of infrastructure, Green New Deals, onshoring, and that stimulus has to be reckoned with, has to be incorporated in one's thinking about the economy, and certainly offsets this horrible 500 basis point increase in the Fed funds rate. Let's see, we got another one here. What is Joe Feshbach thinking of the market in here? I talked to Joe yesterday. It's still the same story. I'll mention it in the morning briefing, but basically he thinks it's a melt up. His tools aren't working here, so he's on the sidelines. He's pretty impressed with what's going on here, but his tools, his experience is that something like this melt ups could lead to meltdowns, and he's just staying on the sidelines. So he's not telling you that it's not going up. He's not telling you it's going down. He's telling you he doesn't know, which I think is an honest appraisal. Eric, we'll take a couple more questions. Will the resumption of student loan payments in August have any effect on your outlook for consumer spending? Not really. I mean, it could be significant for those who have to pay, but I just don't think it's a big enough number to. You put in $5 billion per month. That's I've seen that kind of number before. So that's 60 billion. I would put it more in the soft landing rather than the hard landing story. I don't think something like that's going to cause a hard landing. How worried are you with street S&P year-end forecasts, like latest Goldman Sachs, starting to converge with you over the past week or so, causing a correction in the market soon? Yeah, I mean, I'd rather be a contrarian. I'd rather be alone, as long as it turns out to be right. It can be very painful to be a contrarian and be wrong. So far so good in terms of our bullish outlook for the market. But again, I'm not going to be a contrarian just to be a contrarian. I think the fundamentals, at the end of the day, that's what I'm supposed to be doing, is be a fundamental a strategist and economist. And the fundamentals look pretty good to me. And I think as people are starting to realize that they are and be less concerned about an economy-wide recession, I think that's showing up in the market. I'll take one last one. The Wall Street Journal and others have made a big deal to the 10 billion in student loans. There it is again. Now you're saying 10 billion per month. Okay, so we got 5 to 10 billion per month that are expected to start up again soon. Do you perceive this as a threat to consumer spending? Seems exaggerated to me in this environment, and potentially offset by some of the other gains you mentioned in wages, interest incomes, etc. Yeah, that's my story. I'm sticking to it, as the burglar said. Anyways, look, I hope you guys have a great week. I hate to disappoint you. I really like doing these things, but I won't be doing this next week. My wife and I are going off to Croatia, so we're looking forward to that. Apparently, there's a heat wave over in Europe, and we're expecting when we land there, it's going to be 90 to 95, but then it's going to cool off into the 80s, which sounds pretty good to us. So we're looking forward to it. I'll write the morning briefing for Monday, probably on the baby boomers that I've been talking about, how much money they have. And then Jackie will do a couple of articles. One of them will be kind of an update on everything that we know publicly about artificial intelligence. And Melissa will do something on Europe and the central banks. So we got you covered. And I will take my laptop and do some of these quick takes, which apparently have been pretty popular. So again, thanks for joining us, and see you soon. See you in a couple of weeks.